Hello and welcome everyone to another episode of our knowledge base. And today I'm going to talk about candlesticks and price action. Candlesticks are these movements you see on the chart. Whenever we open a chart, we see a lot of candlesticks. And what are these candlesticks? The first thing we need to know is they consist of different parts. We have the wicks to the downside, the wicks to the upside. We have the candle body, and we have bullish candles that move the price up, and we have bearish candles that are being shown when price goes down. That's the very basic of candlesticks. So what does this in general mean? First of all, the bullish candles are usually shown in red or in green, and the bearish candles are usually shown in red. Since I don't really like these signaling strong colors because they might come with a lot of emotion on the chart, they come with a lot of emotion while you're on the trade, I usually change them to more neutral colors. In this case, I have gold and gray, or when I work with the charts, I just have white and black, or a lighter color and a darker color. It doesn't really matter which color you use, but I don't really like these strong signal colors, red and green. This is why I usually choose different ones. When we look at them more closely, we can, while watching the candles develop, they tell a story. They tell a story about how price actually is moving. In this case, for example, we see the open down here. This is usually defined by the candle body. The candle body always gives us the open of the price. Since this is a bullish candle, we moved up, and we have the close of a price. And in between, we might have wicked down, we might have wicked up, and these wicks represent the highest and lowest parts of the price during the specific time period. Just imagine this would be on the 1 hour time frame. Then this means within this hour, we had an hourly open of the candle at the price here, and we had an hourly close of the candle at the price here. While on the contrary, on the next candle is a bearish candle. So we open exactly where the previous candle closes, which totally makes sense. If we're here at a Bitcoin price of 91,000, of course, the next hour starts with 91,000. And here we see the same. We see how price moved up. We see how price moved down, but this was the open price. And in the end, at the end of this 1 hour, since we chose the 1 hour time frame, we see how we got a candle close here. And this logic applies to all time frames. It doesn't really matter whether you have a 1 second candle or a candle that represents an hour, 2 hours, 4 hours, a day, a week, or a month. And what we need to understand is that this candle contains data. There is data within this candle. On the 1 hour, we only see this chart or this behavior. While this looks pretty clean on the 1 minute, this might look very, very, very choppy. We might see different movements. We might see strong accelerations into one direction or another. But the hourly candle compresses all this individual data into one single candle. So this means the time frame actually matters. Because if we look at higher time frames, if we look at the weekly chart or at the monthly chart, of course, it's much calmer. The price movements we see are much calmer, whereas smaller moves on the 1 minute, 1 second, 30-second, 5-minute time frames might look much noisier. But this is not really a problem because it just depends on your trading style later on. When you like trading the weekly, when you like trading bigger positions or on bigger time frames, meaning you hold maybe spot positions for a longer period of time, maybe for 3 weeks, 4 weeks, maybe half a year, maybe 2 years, you don't really need all the noise from the hourly candles or from the 5-minute candles. They might just distract you. They don't fit your trading style. This is why you need to choose beforehand what trading style you have and what you actually want to achieve by watching the charts. If you plan on holding a position for 6 months, it makes absolutely no sense to watch the 1 minute chart every day. It just comes with a lot of noise and it gives you information you just don't need. You want to concentrate on the bigger picture. Whereas when you're, for example, you want to be a US Open trader, meaning you trade only the move for the first 45 minutes after the US Open, then of course it wouldn't make sense to watch the hourly or the 4-hour chart because it doesn't give you the data and the information you need for that specific move or to catch that specific move. In this case, it makes total sense to go down to the 1 minute, mark out your levels and trade exactly the levels you want to trade. And the next thing that is important is that there's a recency bias in the market. The most recent data is always the most important data. Why is that? I mean, it totally makes sense when you think about a chart, and we will go to the charts in a second. When you think about a chart and you observe recent price behavior and recent patterns, of course, they represent the current sentiment of the market, for example, a strong pump or a strong dump, whereas something you see that has been forming 6 months ago or 8 months ago is not that relevant to your specific trade, to the specific day you're trading right now. And here again, it depends on the time frame, whatever you want to look at. If you look at the monthly chart, yes, of course, something that happened 3 months ago might be very relevant. If you look at the 1 minute chart, what happened around that area 3 months ago doesn't really matter. So this is always very important. Be aware of what you want to trade and be aware of picking the right time frame. So now a next part, and then we will see this in live action on the charts, is understanding price action. These candlesticks, the candlesticks we just talked about, they represent something. Behind these candlesticks, there is the decisions of thousands, maybe 100 of thousands, maybe millions of traders in the specific time frame. So they show you a compressed version of thousands and hundreds of thousands of decisions. So there is something behind that. It's not just a line or a stick we see on the chart. There are real decisions behind that. And these candlesticks therefore represent patterns. They generate patterns, they represent decisions and sentiment, and we can actually observe how these patterns tend to play out in a very specific way. You will probably have heard of many specific patterns like bull flags, bear flags, double tops, double bottoms, rounded bottoms, and so on. There's a lot of these patterns out there, but these patterns represent individual decisions and they give us the chance to interpret the price action on the chart and to somehow anticipate what's going to happen next. We can actually learn how to interpret this behavior, and we can learn on every single candle whether we think that in this specific moment the bulls or the bears are in charge or are in control. And the bulls are usually associated with positive price development, and the bears are associated with negative price development. That means if price pushes up, we generally say that the bulls are in control, and when price pushes down, we say the bears are in control. Now let's move to the specific chart and show you and learn what this actually means. Now let's jump directly into the charts to show you what I was talking about in practice. This is an ETH chart on the 1 minute, and if we just look at this part, this looks on the 1 minute time frame very, very bullish. We see a strong move from the local lows to the local highs. And now let's just put this into context. It's very important to always consider the context of something we're watching. Let's move to the 15 minutes and see if the entire pattern changes. So look at this right now. While on the 1 minute we looked incredibly bullish, this looked like a very, very strong move, whereas in the 15-minute time frame, we have been in a downtrend, in a very strong downtrend for a very long time. And this was just a relief bounce. So while On 1 minute, it looked really strong, like we're trading a really strong asset. On the 50-minute, it doesn't really look like that. Right now, it rather looks like we're inside a downwards move, moving sideways a little bit right now, but not bullish at all. Let's see what happens if we move to the 1 hour. Again, a completely different picture. What do we see here? We have been seeing a strong price increase for a long time, and all we see right now is a quick pullback, which is not that bearish, which is just a very, very healthy price correction. And against this background, this pump now again has a different context. This pump now looks like, hey, we have been very bullish before, then we have been pulling back a little bit, and now we try to push up again. So this looks bullish again. And this is what I want to show you guys by this example. It's very important to always consider the context. Now go to the 4 hour. Again, a completely different picture. If we watch the 4 hour, we have been in a range for a very long time. Going up, going down, going up, going down. So on the 4 hour chart, this move, first of all, it's not really visible. The data is so compressed that we cannot see anything in here. But we don't even have a clear picture. We might say this is rather bearish. We might say this is a very strong sign of a reversal right now with this rounded bottom structure. But right now, what we see from here, the picture changed again. And this is so important. And this is what you really need to understand. It's always important to watch the candles, to watch the price action, and to put it in context of what you actually want to do. If I want to invest in ETH for the next 2 years, this might be a very, very nice reversal point, saying, hey, we're coming from a local high, we came down here, we show some signs of accumulation and some signs of a potential reversal, so this might be a good point to enter a long-term position. Whereas on the 1 minute, this might be quite the contrary. So just to keep this in mind, context matters, and you cannot trade a chart without knowing the specific context you're in. Now let's watch the price action a little bit more in detail. If we go back to our 1 minute example, I just want to show you what we usually look for. Now you already know the picture, but let's use the replay button and go through some ideas. I want to show you what we can actually see here. Okay, we see how price went down pretty steeply, and the first thing we see, and this is what we need to take into account when we watch price action, is how do the candles move? What do they tell us? For example, here, we saw how price sold off very, very heavily. On the other hand, seeing this wick, what does this mean? This means that the bulls started taking control here. And they started pushing the price back up. They didn't want to have the price down here. So they obviously thought that this is a very good price to get in. And we see immediately how price pushed back up. The same here. Strong candle, bulls stepped in, pushed the price back up. And the same we see here after the, again, steep down move. Price was pushed back up. We have a long wick. A long wick is always a sign for potential reversals. And immediately afterwards, we see this strong push. A very, very strong candle. These candles are called engulfing candles because they engulf several other candles. Sometimes just one, sometimes two. In this case, it's 1, 2, 3, 4, which is a very bullish sign. And this candle even closes above the candle close of the bearish move before. So we have a break of structure. Then what do we see? We see some sell-off down here. We see how we have this wick to the downside, another wick to the downside. So bears are taking back control. And now we push down. And what we see, while we are retesting this level, again, these wicks to the upside. So obviously, people are stepping in here. People think this level needs to be bought. And what we see, again, 3 white, big, strong candles, showing us that obviously this move was very significant. Now, what else do we see? Was this really a reversal? Yes, we can see how price pushes back up, and every time the bears are selling into these levels, we see how it's being bought up aggressively by the bulls, pushing up the price. And again and again and again. And whenever bears are trying to push price back down, we see these small accumulations and price breaks out again. This is something we always need to keep in mind. Whatever we do, we need to watch the price action. What do we see here? We see some sort of accumulation. Accumulation zones are usually great to trade because they give us an anchor. We see we had a strong push. We see price accumulates here. Now it's very simple. I could just enter here and long the breakout, short the breakdown, or when I long the breakout, I could set my stop loss easily below that line, which shows me, hey, this is where my idea of a bullish continuation might be wrong. I'm wrong. I'm wrong as a trader all the time. It doesn't matter. The only thing we want to take care of is that we earn more than we lose when we are right. So the few ones when we're actually right, we want to make some money, and this money needs to be more as compared to the amounts we lose when we're not right. In this case, everything is fine. And you know my video about risk management. If you haven't seen it yet, please watch it, which tells you all the details about how to set this up. So what do we see here now? We have this accumulation. Okay, this would have stopped us out. That happens. But what we see is a stronger move to the downside. Okay, so we wait. Now we break back up. Okay, our trade would be gone in this case. It doesn't really matter. That happens. Now again, we watch price move sideways. And again, now we see that we have a bigger accumulation. So depending on your strategy, this again is something we could actually trade. We see, okay, the accumulation now is from here to there. So let's watch the 1 minute. Let's try to long this breakout, which would be something like this. The price target, I will not talk about this right now. It doesn't really matter. We just target 1.1 more or less. We say, okay, our invalidation would be below here. This is very, very simplistic, guys. This is not a trading tutorial. I just want to show you how price can actually tell a story of bulls fighting versus bears. And what happens now? Let's see again. We have this strong accumulation again and again, and there we see the breakout. Here we have our breakout, which means we move this and watch what happens. We see how we pushed back down into these local lows. Bulls were taking control. We have a strong candle. It wasn't an engulfing, but we saw another strong white candle followed by a quick and very, very tiny pullback, followed by two big candles. This is usually a good sign for a continuation move. Now we just want to break this local high, and we can be pretty bullish about this move. And look what happens. We see how we move up, and we actually move into the winning zone. Price comes back down. This happens all the time. And now we shoot up. There we go. Without going into details, this would be more or less a winner now. Maybe it comes down a little bit. Maybe we would have cut here. It doesn't really matter. The idea is to watch the price and to watch what we can do. Here, what we see is another local high formed by a strong wick. So this might be a very important point to think about cutting my trade. Maybe I cut this trade at the next local swing high. This is where we were. Let's see what happens. We might still want to lock in some gains. So we might consider cutting this here if we break below that. There we go. We broke below that. We're out. We still closed at a profit, but this swing high and this potential reversal sign gave us an indication. Okay, up here, bears are taking control and bears managing to push us back down with, again, two strong candles. Here, while bulls were trying to take control, we were moving down, and again, nothing really happened. Bears were still in control. Let's see how this would play out. We cut our trade. That's all good depending on the trade rules we defined. We are fine with some profits, and we just observe what's happened next. So again, I don't want to be in this trade anymore. This is taking too long. Usually in these sort of 1 minute trades, we can trade quick and aggressive moves to the up or to the downside. If price starts stalling and if we don't see a clear direction, this is what we see here. Again, we see this ranging behavior. This makes our trade uncertain, and this might be a good reason to leave this trade, which we already did. We already used the swing high to leave it. So this is just the most important thing I wanted to show in that video. We can actually see how a specific story plays out. At what point are bulls taking control? At what point are bears taking control? And there's many more aspects to that, and there will be many more ideas on how to learn and how to trade that. But this is a very important base of everything we do on the charts. Learning how the price moves, learning to interpret this, getting a clean thesis on what we want to see, and trade these theses. If it works out, great, we make some money. If it doesn't work out, our risk management will take care of us not losing too much, of only losing what we're willing to lose. So, I'm happy to see you in the next videos. That's so far everything I wanted to show you about candlesticks and price action.